I'll get it if I want it.
All right, Real Estate Talk Podcast. Welcome back, ladies and gentlemen. This is going to be a data dump for all you guys out there. So we are looking and analyzing at some of the trends that we're seeing on the market. We're looking at some of the economic data that just came in recently, and there's a lot to take in here, and there is some very uncertain waters ahead. Stay tuned. We want to present you with all the facts that we can so that if you are making purchasing decisions or selling decisions in the future or investment decisions, that you can take this data and apply it to your overall strategy. Stay tuned as we get into it. Hey, welcome back to the Real Estate Talk Podcast. Rob Keilman.
Joshua Britt.
All right, Josh. Now we have the economic data that came in. How is the U.S. housing market looking right now?
Well, so first and foremost, there was a lot of days where it looked like we were, possibly on the right track,
Yeah.
We started out with the ISM manufacturing data that came out, and the data came out lower than expected. It showed future contracts decreasing, the backlogs decreasing, which could be troublesome. And again, we are, because we're trying to pull off the Feds and everybody's trying to pull off this soft landing, what may be good news on one front may be bad news on another front. Meaning, with lower contracts coming in and, the backlog clearing up, at some point, if there's not new orders coming in, manufacturing jobs may be at risk, right? So it's kind of a good news, bad news story. And basically, you can apply this across the board on everything. Then the Jolts report came out, which is a survey of job openings in the United States, and it was the worst reading since February of 2021. Now, you have to think about where we were as a country in February 2021. We were in the middle of the COVID pandemic. Most people were working from home. Most businesses weren't taking on new hires or looking for more workers. There was so much uncertainty still, just about 10 months into the COVID pandemic. Everyone was glued to the nightly news and seeing a death toll number that was rising out of control. So for the Jolts report to put us back in that time frame, that can be unnerving, especially if you are a person who maybe has some concerns about your job. There's been a number of companies that have announced recent layoffs. So, if you're concerned about where your job is or where you're going and, what the possibility is of you leaving one job and going to another job, it can be concerning. Or if you're at a job you really don't like and you're thinking like, I'm just going to leave this one and go find another one, you might want to think twice about that theory right there. Might not end so well for you. Also, OPEC came out, announced that they're going to phase out production cuts. It's going to essentially put about 2.2 million barrels of oil back into rotation, which is the expectation is that it's going to lower energy prices and could help potentially affect inflation, positively affect inflation and interest rates.
Yeah.
A good friend of ours sends out weekly updates on the interest rates, daily updates on the interest rates. For mortgages. We were trending in the positive. It was a green lit board of interest rates, which was very welcome. Especially
green lit means they were coming down or going up?
Yeah, they're coming down. They're coming down. So, for anybody out there who is looking at potentially, buying a house, the interest rates were trending down. We got the ADP employment numbers, and the report showed 152,000 jobs created, which was fewer than expected. Small businesses lost about 10,000 jobs, and the leisure and hospitality industries added only 12,000 jobs. So with this report, if you were a betting person, you would have bet the overall jobs report would have come in low. And as of right now, at that point in time, they were pricing in a probability of 67% probability that there would have been an interest rate cut coming in July. So this was more welcome news. Got that daily market report for interest rates. And again, it was green and it was trending even lower than it was the day before. The European central banks cut their rate by 1/4 of a point. So again, just more excitement building that, okay, we're probably finally at that last hurdle, and we can see that the interest rates in the United States will probably be cut soon. And a bombshell jobs report came in at 272,000 jobs added to the labor market, and what was expected to be at or around 185,000, we came in almost 100,000 jobs over the expectation, and really conflicting data. I mean, you know, when you go back to Wednesday, you look at the ADP numbers at 152 coming in lower than expected. You have small businesses saying they lost 10,000 jobs. You have in leisure and hospitality saying they lost 10,000 or 12,000 jobs. You're not expecting a jobs report to come in almost 100,000 over. So obviously that jobs report pretty much killed any opportunity or any hope of a July interest rate cut, which basically continues the narrative of higher interest rates for longer.
Yeah.
And that's where people really started questioning, like, how is this possible? How is it possible that when every other piece of data says that the economy is in a downward trend, do you have a jobs report that comes out and just blows away the expectations and the estimates?
Makes it seem like the economy's doing fantastic.
It does.
Which means you can increase interest rates more.
Or you can keep them higher for longer. And,
right.
You know, you even go back to last year, right? In 2022, the end of 2022, everyone expected in 23 there was going to be a recession.
Mm-hmm.
U.S. economy is going to hit a recession in 23. It was like people were like, they would bet the house on it, right? Yeah. And every single report in 23 was basically the U.S. jobs market remains resilient. The U.S. jobs market is just phenomenal. And, you know, and it really propped up when everything else was negative, it made it seem like it was a positive situation, right? But when you start diving into, well, how was the jobs market? How was that jobs report created, right?
Yeah.
They do a survey. They survey businesses and they survey households.
Okay.
They survey businesses to say, hey, Robert, how many jobs did you add to the economy in May?
I don't know, like 100, 1,000, 10,000.
Okay, 10,000. Great,
yeah.
Great job, Robert. We really appreciate what you're doing for the economy. 10,000 jobs created. Check. 10,000. And, you know, depending on who's doing the surveying and what the narrative is,
who they're calling, yeah,
you know, but they're clearly not calling the companies that are announcing layoffs.
No,
I'm not going to call Microsoft after they just announced layoffs to their cloud computing divisions. I'm not calling any of the others, Tesla, who announced layoffs. I'm not calling any of those companies because they publicly already said they're laying people off. So why would I call them?
Right.
Unless I want a negative report.
Right. Which is not
so
good.
If I'm looking for something positive, I don't call the people who are saying they're negative that they're laying off, which, you know, in our preparation for this episode, we went through a laundry list of companies who said they were laying off people.
Yeah.
And it was, you know, it was a significant number of companies who were laying off.
Right.
So obviously we don't call them if we're doing a survey and we want a positive number.
Yeah.
Then the second part is we call households and we ask, hey, how many people in your household are employed? And this is how we come up with our employment number, which is the second part of the jobs report. The first part is the total number of jobs that were created. And the second part is the employment number. Well, it went from a 3.9 to a 4%. So we're saying we added all these jobs, but yet the unemployment rate still ticked up. So where's the reality here? Where's the middle ground? What's the truth?
Well, the truth is this, and right now, and this is, I'm just going to put the lay of the land out here. And for everybody out here, when I'm about to go through some of this data with you, the reason why we focus a lot of times on mortgage interest rates, a lot of times you might have heard of previous podcasts that we talk about it, is because the home buyer, the one making the purchasing, is the most important factor in all of real estate. Which means if you're a home owner and you're trying to sell, if nobody buys your house at a good amount of money, then you don't make as much money. If there's less buyers out there and you need to sell it, you might have to put a fire sale to get rid of it. That's what we're talking about. It drives everything. It drives the banks so they can loan money to consumers. Consumers can pay their mortgages, and that's an income for the bank that keeps the bank lending, because they do the 10-to-1 ratio. Fractional dollar. The reality here is we're over $33 trillion in debt. That's what the U.S. Treasury is holding, about $33 trillion in debt. And as of right now, we are spending more money as a country than we're taking in. I think right now the debt is 123%. So GDP, what we produce, the amount of money the country as a whole makes, per our debt, we're at 123%. So if you made $100,000 a year, add $23,000, that's what you're spending, $123,000. That's not sustainable for the future of our country. Now, let's take in some other things. Now, you mentioned, well, I'm not going to go into this one yet. I'm going to bring this here, but let me go through, not this one. There's so much data here today. We talked about businesses, that were laying off employees, right? Well, there's a number of known businesses right now that are facing bankruptcy. Petco being one, Joanne being another, Express, that clothing store in the mall, AMC, Big Lots, Kohl's, Foot Locker, Steinmart, the Container Store, JCPenney. These are known brands that are iconic brands that are facing failure. Tech companies, Microsoft, Google, Amazon, Tesla, TikTok, and Snap have all made significant cuts. In January, Microsoft laid off 1,900 video gaming employees, and in June, they laid off 1,500 Azure cloud employees. Google has also laid off hundreds of workers in 2024. Other companies like Lucid Group, that electric car manufacturer, it didn't say how many, but it says cut 400. Hundreds of 400 jobs.
I've seen that in another report, 400.
Nike, the shoe company. Did they talk about their layoffs?
No, it didn't say exact. It didn't say an exact number.
Yeah, Discord, 170 employees. Citi, the company's planning. Citigroup, the company's planning to cut 20,000 employees as part of a corporate overhaul. BlackRock, big investment firm, planning to cut 3% of its staff. The biotech advocacy organization, laid off 30 people in May. Araska, a San Diego-based biotech, laid off 18% of its employees. FedEx, company shutting down 4 facilities in Florida, which will result in the layoffs of 220 couriers and 8 managers. So those are some known businesses, and we got to take this into another perspective. Personal savings of consumers are down. That's going to affect what people can buy, including houses. It's also going to affect the less money that's in the bank will affect lenders, banks, and how much they can lend out. Remember, it's a fractional dollar, right? Another thing I think is also tied is discretionary spending on needed items. So food, we all know that's inflation's up. Fuel, hopefully it'll come down now with the OPEC producing more barrels. But also if you don't have a house, the other important purchase is a car, so you can get to and from work, to and from the grocery store, and whatnot. Well, we remember during the pandemic, if you were buying a car during the pandemic, that was the worst time in the history of I've been alive to buy a car. And it just so happens my lease on my Audi was up, and I needed to go get another car. Oh my God, that was horrendous. I had to go across state lines looking for a damn car. But since there was no cars on the lots, when I was going through, there was like literally no cars on the lots during the pandemic. Well, I could tell you now that inventory is piling up at dealerships across the U.S. I mean, we break it down to days supply. So if they were selling cars by the day, this is how many days of supply they got on their lots nationwide. You think about Chevy, 87 days.
Yep, almost 3 months.
But that is actually wonderful. You know, little
in comparison,
Alfa Romeo, nobody wants them. 260 days worth of supply.
Yeah,
that's part of Stellantis Group. And if you got 260 days supply in the market, just stop producing cars. Try to sell what you got.
You're almost at 9 months supply. You got cars for the next 9 months. Don't build any more of them. There's no sense in building any more of them. You got 9 months. The cars are going into 25. Jaguar,
202 days of supply.
Yep. Over 6 months. It's June. You got cars for the rest of the year.
Yep. Chrysler, 165 days of supply. Dodge, 156 days of supply. And the list goes on and on. Genesis, 173. Even, you know, popular vehicles like the Ford F-150, 83 days of supply right now.
Yeah. How about Jeep? Jeep's a good American vehicle.
Jeep, we're sitting at 195 days of supply.
Wow. That's unreal.
I mean, you can't keep charging
60
to 70,000 for a damn loaded Jeep. It's like Sahara or whatever the heck. You know, I'm not a Jeep fan, but they have these higher trim levels that cost a butt ton of money. So can't keep selling them at that price. But the good news is, if you are in the car market, you know, look, and you happen to be in that position to buy one, I would check out some of these with loaded supplies. Now, your Hondas, your Toyotas, types of vehicles, they're not having an inventory problem.
No.
They're still going well. And now the average time a consumer is expected to hold a vehicle is now up to 12 years. So now we have people keeping cars longer. Personal savings are down. Credit card debt is at $1.1 trillion. The largest amount of debt, credit card debt, in the history of the U.S. We're spending 23% more than our GDP. So, how are mortgage applications right now?
Mortgage applications are scarce, to say the least. And you know, another troubling statistic there is and this is how a scenario where you can see a seller's market quickly turn into a buyer's market. We had the lowest week, second lowest week of mortgage applications last week since the beginning of the year. Second lowest. And just 2 weeks ago, we had the second highest number of weeks for refinance applications. And you may say, why would anyone be refinancing their mortgage at a time like we're in right now?
Because they would have a lower mortgage rate and they're going to refinance to a higher rate.
Most of them would have clearly a lower interest rate. So why would they refinance from a lower interest rate to a higher interest rate? It is indicative of the fact that there are people who are struggling with everything that we've said. You know, if you are, you know, if this video happens to get to the Federal Reserve or anybody in a decision-making position, this statistic is very, very critical to the awareness of where we are as a country, of where the American people are. If people are being put in positions to refinance their house into a higher mortgage rate in order to get
significantly
capital
in a lot of cases
to pay off debt, that means they're in a very bad way.
Yeah.
They're in a very bad way. And so for us to have refinance applications at the highest level all year 2 weeks ago, and new mortgage for purchase applications at the second lowest week of the year, this is really an indicator that you're going to see this seller's market that everyone's been enjoying quickly turn around and go into a buyer's market. So with all that said, if you are in a position to buy or you're thinking about buying soon, you should really shop around, and you should be working with an agent who's going to be able to be a pit bull for you and get you the best possible deal. And I wouldn't necessarily worry about, what if we miss out on this house? Because I think we're going to be in a period of time where if you're working with a really good agent, they're going to be able to negotiate your closing costs being paid for you, and they may be able to negotiate that, you get a lower price off of what the list price is. And that's just going to be purely due to the fact that there's a low number of the second lowest week. That the lowest week was in February. So for the last 3 months, this is the lowest week for mortgages.
Yeah, as inventory increases, we're going to start seeing home prices starting to correct here. I was reading some reports, and I'm not trying to pick on you, Florida. You are one of my favorite states to vacation and tour. But I have read some reports that the inventory across the state of Florida is up as high as 1,000%.
Yeah.
And if mortgage applications are down, which means you got less buyers and higher inventory, I would venture to say that some parts of Florida might be seeing some significant price adjustments going forward. Now, real estate is hyperlocal. As we have talked about a lot of times, what's in our market may not be in another market.
Yeah.
So it really just depends on what your housing inventory is and how much demand it is for housing there. So it's going to be very, very choppy waters as we're getting through this, as we're putting out this data. But what it comes down to simply is people have less money. Jobs, economic data, even though it says it's really strong, it's not across the board. We just talked about where the layoffs are happening. So I was like, okay, well, if certain companies are laying off, getting rid of employees, what industries are actually hiring people? Well, no surprise, it's healthcare.
Yeah.
So unless you want to spend 10 years in college and all the other training you have to do to become a doctor or a nurse or some sort of medical related field. The other one was transportation.
Yeah.
So truckers, think about Amazon stuff, delivering things to and from, retail trade, wholesale trade, construction because of housing, government. I don't like seeing government hiring because they take taxpayer money and hire employees, and it just feels like it adds more debt. Financial activities, and the smallest one was leisure and hospitality. And everything else is negative after that.
Yeah. Yeah. So you spoke about local and how all of the markets are kind of hyper local when it comes to real estate. So, just some numbers right here where we're at in the southeastern portion of Virginia. We had 735 new listings in the past 7 days. That's actually a really high number for us in this area. Probably one of the higher numbers. I look at these numbers every week, and it's one of the higher numbers. There's a few, maybe I can count on one hand how many times this year we had a weekly number of new listings at 700 or above. But price decreases, 429. That is probably the highest of the year. The number of prices decreasing. So those houses are staying on the market longer. The sellers are getting anxious. They're reducing the price. They're trying to get people in. Meanwhile, purchase applications are in the tank. Second lowest week all year for new purchase mortgage applications. So you have a number of houses being decreased in their price. You have a large number of houses coming on the market. We still have a decent amount of people buying. We have 540 that went pending and 635 that closed. However, at some point, the numbers start to shift in the buyer's favor, and it quickly turns into a buyer's market. So that's why, again, I reemphasize, if you are a buyer, you're out there right now, get with an agent who's going to be a pit bull in your corner, who's going to fight for you to get your closing costs paid for and get you the best possible deal.
Yeah, absolutely. Because these prices, the inflated price point, it could be coming to an end here, or stabilizing rather, across the board in the U.S. in all markets, if it hasn't already, because it's already started happening corrections in some markets. But as we go forward with mortgage applications down, people need jobs to buy houses, that economic data coming down, personal savings rate down, credit card debt increase, refinance applications ahead of time.
Yep.
People are having a bad financial position right now. And we even talked about price of food and all that other stuff that's ridiculously high right now. So we are going to, the problem is, another problem is I was looking at trying to find the foreclosure data. I want to see how many foreclosures are banks starting to do. And I found very minuscule amount of information so far. The only thing I found, well, not the only thing, but one of the things recently I found was that in Q1 2024, U.S. foreclosure market reports, this was according to Adam. Adam is a leading curator of land, property, and real estate data. It showed a total of 95,349 U.S. properties with a foreclosure filing during the first quarter. That's up 3% from the previous quarter, but down less than 1% from a year ago. So it just seems like it's slightly higher than usual. Where are all the foreclosures at?
Well, this is a difficult position, especially for banks, because they don't want the negative assets sitting on their books. And so, there was a report that came out recently that the FDIC has 63 problem banks on their list. And, these are banks that they've identified as having issues. And it also said that there was an estimated $517 billion in unrealized losses. And you start to ask, well, why would you not want to realize your losses? Like if you have that much in losses, why would you not realize that as a loss? Well, if you realize it as a loss, then it starts affecting your ability to lend and generate other additional income. So, this was something that we seen back in 2007, 2008. Now, let me make it clear. I do not think that we are, in that type of a position. And I think that the people who are watching this they have eyes on it. Whereas in 2007, 2008, when the housing market collapsed, I think everyone was asleep at the wheel. I don't think that's the case now. So I think that it's known, it's something that's being watched. And I think at some point, someone says, hey, you need to start taking these unrealized losses. Now, why that's important for everyday Americans, especially homeowners, is if there is a backlog of foreclosures that are not being realized as losses, and banks start realizing those as losses, and then they start dumping them on the open market, well, quickly home values go down because more inventory. So it's just something to be aware of if you're a homeowner. And, if you're a seller right now and your house is on the market and you want to play hardball,
It's not the time to play hardball.
it's not the time to play hardball.
Yeah,
Don't
I would
play
list more
hardball.
conservatively and let the market determine.
That's right.
Where it goes.
Get the house on the market, let people come in there. This is the wrong time to try to play hardball. You should be grateful and very thankful if you should get an offer on your house. And I'm not saying that you need to be soft about it, but you have to have a realistic expectation that with mortgage applications at the second lowest week of the year, that right now, based off of all the data we've seen from last week and where the country stands as a whole, you're going to continue to see a downward trend of buyers applying for mortgages, which means there's going to be fewer buyers to buy more houses. And so therefore, you don't want to play hardball. You're going to lose every time.
Yep.
So, but if you don't need to sell, well, then you have that luxury of not needing to sell. But if you're in a position where you have to sell, your job is requiring you to go somewhere else, you're relocating, your military relocating, or you're just in a tough spot and you got to sell, well, you got to do what you got to do. And now's not the time to play hardball.
Anything else?
That's it. Let's wrap it up.
All right, guys. You like this video, hit the subscribe button. Leave a comment below. Let us know what you think. What is your sentiment on where the market is going and all the things that we just talked about? As you digest that, let us know your thoughts. With that, thanks for watching. See you soon.